When you hear the phrase financial market, what comes to mind? For some people, it sparks excitement. The thought of Wall Street stock tickers running across screens and the possibility of making money while you sleep. For others, it brings feelings of fear or confusion, like entering a casino where the rules seem rigged against you. But the truth is, the financial market isn't just for the wealthy elite in suits or the math geniuses staring at complex charts all day. It's for anyone who wants to build wealth, secure their financial future, and learn how money really works in the modern world. And here's the key idea to start with. Investing isn't about getting rich overnight, it's about building wealth over time. Let me put it this way. Imagine planting a tree. On day one, it looks like just a fragile little twig poking out of the soil. But if you water it regularly, protect it from storms, and let time do its magic, that twig becomes a strong tree that can provide shade, fruit, or even wood. Investing is very similar. The earlier you plant your seeds, the money you put into the market, the more you allow time and compounding growth to do the heavy lifting for you. Let's face it, just relying on a paycheck isn't enough anymore. The cost of living keeps rising. Inflation quietly eats away at the value of your savings, and traditional pensions are becoming rarer by the day. Even if you're disciplined about saving money in a bank account, the interest rates often can't keep up with inflation. Here's a simple example. Let's say you save $10,000 in cash, and inflation is just 3% a year. That means every year, the buying power of your money shrinks by about. In 10 years, your $10,000 would only feel like around $7,000 in today's terms. You didn't lose the money, but you lost what it can buy. That's why keeping all your savings under your mattress or even in a regular bank account isn't enough. This is where the financial market steps in. By investing, you're putting your money to work. Instead of just sitting idle, your money participates in the growth of businesses, industries, and even entire economies. And when those grow, your wealth grows with them. The financial market isn't one single place. It's more like an entire ecosystem, made up of different types of markets where people buy and sell financial instruments. The stock market is probably the most famous one. Here, you're buying ownership shares in companies like Apple, Tesla, or Amazon. When those companies grow and make profits, you benefit. The bond market works differently. Instead of owning part of a company, you're lending money to governments or corporations. In return, they pay you interest. Then there's the forex market, where currencies are traded. If you've ever traveled and exchanged dollars for euros or yen, you've already touched this market. Commodities markets are where people trade raw materials like gold, oil, coffee, or wheat. And of course, we can't ignore newer markets like crypto, where Bitcoin, Ethereum, and other digital assets are reshaping how people think about money. Each of these markets comes with its own risks, rewards, and strategies, but together they make up the financial market, a global system that never really sleeps. Here's where most people misunderstand investing. They think it's all or nothing. You're either a complete beginner with no clue, or you're a stock market wizard making complex trades every second. The truth is, investing is a journey. Beginners often start with simple strategies, like buying index funds or putting money into retirement accounts. These methods don't require constant attention, but still let you benefit from long-term market growth. Experts, on the other hand, might engage in advanced techniques like analyzing company balance sheets, using technical charts, trading options, or even running algorithmic trading bots. But here's the good news. No matter where you are on the spectrum, the underlying principles remain the same. It's about understanding risk, staying disciplined, and letting time work for you. One of the biggest myths about investing is that it's gambling. People see the ups and downs of stock prices and think, that looks like a roulette wheel. And yes, if you treat investing like a slot machine, putting in money randomly, chasing hot tips, or betting your life savings on a single stock, it is gambling. But smart investing isn't about luck, it's about strategy. Gambling is about making quick bets with uncertain outcomes. Investing, when done properly, is about making informed decisions with long-term growth in mind. Warren Buffett, one of the most successful investors in history, once said, The stock market is designed to transfer money from the active to the patient. In other words, those who panic and chase trends usually lose, while those who stay calm, consistent, and patient usually win. Let me share a simple story. Imagine two friends, Sarah and Mike. Sarah starts investing at age 25. She puts just $200 a month into a broad market index fund and does this for 10 years. By the time she's 35, she stops investing entirely but leaves her money in the market. Mike, on the other hand, waits until he's 35 to start. He invests the same $200 a month but continues all the way until he's 65. Now here's the twist. Even though Sarah invested for only 10 years and Mike invested for 30 years, by the time they both reach retirement age, Sarah has more money than Mike. Why? Because Sarah gave her money more time to grow. Compounding, earning returns on top of returns, did the heavy lifting. Time, not timing, is the most powerful factor in investing. So why are we here? The purpose of this guide is simple: to break down the complex world of investing into practical strategies anyone can understand, to give beginners the confidence to start without fear, and to give more experienced investors insights into advanced methods. Whether you're someone who just opened your first brokerage account, or you're already experimenting with technical indicators and trading strategies, this guide will help you grow. Because at the end of the day, investing isn't just about money, it's about freedom. The freedom to retire comfortably, the freedom to provide for your family, and the freedom to live life on your own terms. And with that, let's move forward and start laying the foundations, beginning with the very basics of how the financial market works. When most people hear about the financial market, it can sound intimidating, almost like a secret club where only economists or Wall Street traders are allowed in. But in reality, the market is just a system, a meeting place where buyers and sellers come together. It's no different in principle from a local farmer's market, except instead of apples, bread, and vegetables, people are buying and selling stocks, bonds, or currencies. Once you look at it this way, the mystery begins to fade. At its core, the financial market is built on very simple ideas. A stock, for example, is nothing more than a slice of ownership in a company. When you buy a share of Apple, you become a part owner of Apple. You're not running the company, of course, but you do get to participate in its success. If Apple makes profits and grows over time, the value of your shares grows too. And in some cases, the company might even share its profits directly with you through what are called dividends. Bonds work a little differently. Instead of buying a piece of ownership, you're essentially lending money. Imagine the government needs to build a highway, or a corporation needs to fund a new factory. They might issue bonds, which are like IOU. When you buy a bond, you're lending them your money, and in return, they agree to pay you back with interest. It's more stable than stocks in many cases, but usually the returns are lower too. It's a trade-off, less risk, but also less reward. Then there are mutual funds and exchange-traded funds, or ETFs. These are like baskets that hold lots of different investments inside them. Instead of buying one stock or one bond, you're spreading your money across many. Think of it as ordering a combo meal instead of just a single dish. You get a little bit of everything. For beginners, this is often one of the smartest ways to start, because it gives you instant diversification. Even if one stock in the basket performs poorly, others might do well, balancing things out. Understanding risk and reward is another cornerstone of investing. Imagine two friends, one who loves roller coasters and another who prefers calm walks in the park. Investing works in a similar way. Some people are comfortable with the ups and downs of high-risk investments like cryptocurrencies or tech startups, while others prefer the steady, predictable pace of bonds or blue-chip stocks. There's no one-size-fits-all answer. It all depends on your goals and your tolerance for risk. A helpful way to think about this is with the idea of diversification. You've probably heard the phrase, "Don't put all your eggs in one basket." If you drop that basket, all your eggs are gone. In investing, the same principle applies. If you put all your money into one stock and that company fails, your entire investment is at risk. But if you spread your money across many different assets, some stocks, some bonds, maybe even a little in real estate or commodities, then a single failure won't wipe you out. It's about balance. And balance is key, because the market isn't always smooth. It has its ups and downs, sometimes in dramatic fashion. One day the news is full of headlines about record-breaking highs, and the next it's about crashes and recessions. For a beginner, this can be nerve-wracking. But once you understand that these fluctuations are normal and part of the long-term cycle, you stop reacting with fear. Think about it like the changing seasons. Just because winter is cold doesn't mean spring won't come. Similarly, a market downturn doesn't mean the end of the financial world. It just means you need patience. To really see this, let's look at history. The stock market has faced wars, financial crises, political turmoil, and even global pandemics. And yet, over the long term, it has always trended upward. There have been painful drops along the way, yes, but those who held on and kept investing eventually saw growth. Beginners often panic during downturns, selling off investments in fear. Experts, on the other hand, see downturns as opportunities, like a clearance sale where great companies are temporarily on discount. Now, if you're just stepping into the financial market for the first time, it's important to remember that you don't need to know everything on day one. You don't need to be able to read complex balance sheets or analyze currency fluctuations like a professional trader. What you do need is a foundation, a clear understanding of what you're buying, why you're buying it, and how it fits into your larger goals. Think of it like learning to drive a car. The first time you sit behind the wheel, you don't know all the mechanics under the hood, and you don't need to. You just need to know how to steer, when to hit the brakes, and how to read the signs. Over time, you get more comfortable, maybe even learning to handle more challenging roads. Investing is the same. You don't start as an expert. You start with the basics, build your confidence, and grow from there. That's why understanding the fundamentals of the financial market is so powerful. Once you grasp the idea of ownership through stocks, lending through bonds, diversification through funds, and the relationship between risk and reward, you have the foundation to make decisions with clarity. From there, everything else, the strategies, the analysis, even the advanced techniques, becomes easier to understand. And here's the most important thing to keep in mind. You don't have to be rich to start investing. Too many people delay because they think they need thousands of dollars to begin. The reality is, even small amounts, invested consistently over time, can grow into something meaningful. Thanks to modern platforms and apps, you can start with as little as $5 or $10. It's not about the size of your first step, it's about the consistency of your steps over time. So as we move forward, keep this picture in your mind. The financial market isn't a giant, mysterious machine designed to confuse you. It's simply a system where your money can grow by participating in the growth of the world around you. And as long as you understand the basics, ownership, lending, risk-reward, and diversification, you'll already be ahead of most beginners who jump in without this foundation. Now that you've got a sense of what the financial market is and how it works at a basic level, the next big question is, how do you actually get started? For many people, this step feels like the biggest hurdle. They think, I don't have enough money, or I don't know the right strategy, or even, what if I make a mistake and lose it all? Those thoughts are normal, but they can also hold you back from ever beginning. The truth is, starting to invest doesn't require perfection. It requires a plan, patience, and a willingness to learn along the way. The very first step is not even about investing itself. It's about knowing your goals. Ask yourself, why am I investing? Is it to save for retirement, to buy a home in 10 years, to build a college fund for your kids, or maybe to achieve financial freedom earlier in life? Having clarity about your destination is like setting the GPS before you start driving. Without it, you might still move forward, but you'll have no idea where you're going or when you've arrived. Short-term goals, like saving for a vacation or a car, might not be the best use of investment money because the market can be unpredictable in the short run. Long-term goals, however, like retirement or wealth building, are where investing shines. But before you put even a single dollar into the market, you need to take care of something even more important, your safety net. Imagine jumping into a pool without knowing how deep it is. Risky, right? That's what it's like investing without an emergency fund. Life is unpredictable. Cars break down, medical bills pop up, jobs can be lost. If you don't have some money set aside for emergencies, you'll be tempted to pull money out of your investments the moment life throws you a curveball. And that can hurt, especially if the market happens to be down at that time. A good rule of thumb is save at least 3 to 6 months worth of living expenses in a separate, easily accessible account before you dive into investing. Think of it as your financial airbag. Once you've got that foundation in place, the next step is to choose your entry point into the market. In the past, investing required calling a broker on the phone, filling out paperwork, and paying high fees just to make a single trade. Today, it's never been easier. With the rise of online platforms, investing apps, and robo-advisors, you can start in minutes from your phone or computer. The challenge now isn't access, it's choosing the right platform for your needs. If you want the simplest, hands-off approach, robo-advisors might be the perfect fit. These are automated platforms that take your money, ask you a few questions about your goals and risk tolerance, and then build and manage a diversified portfolio for you. It's like having a financial advisor in your pocket, but at a fraction of the cost. On the other hand, if you like more control and want to pick your own investments, a brokerage account with a firm like Vanguard, Fidelity, or even app-based platforms like Robinhood can give you that flexibility. There's no universal best option here. It comes down to how involved you want to be. Now, here's something important. When you do start, you don't need to go all in. Many beginners think they need to wait until they have thousands saved up before it's worth it. But the truth is, the most powerful tool you have is not the size of your initial investment, it's time. The earlier you start, even with small amounts, the more time compounding has to work for you. For example, let's say you only invest $100 a month. That might not sound like much, but over 30 years, with average market returns, that could grow into well over one. And if you increase it gradually as your income grows, the numbers become even more impressive. One of the smartest methods for beginners is something called dollar cost averaging. It sounds fancy, but the idea is simple. Instead of trying to time the market, guessing when prices are at their lowest, you invest a fixed amount of money at regular intervals, say every month. Sometimes you'll buy when prices are high, sometimes when they're low, but over time the average evens out. More importantly, this strategy removes the emotional roller coaster of trying to predict the perfect moment, which is something even experts struggle with. Of course, getting started isn't just about putting money in, it's also about building the right mindset. One of the biggest mistakes new investors make is expecting quick results. They look at their account after a few months, see it hasn't grown much, or worse, that it's gone down, and they panic. But investing isn't a sprint, it's a marathon. The real rewards come not in weeks or months, but in years and decades. Think of it like planting a garden. You don't dig up the seeds after 2 weeks just because you don't see fruit yet. You trust the process, water consistently, and let time do the rest. Another trap to avoid in the early days is comparing yourself to others. It's tempting to hear stories of someone doubling their money in crypto or making thousands overnight trading hot stocks. But for every one person who brags about their winnings, there are dozens who quietly lost everything chasing those same dreams. Remember, your journey is your own. The goal is not to win some imaginary race, it's to build lasting wealth for your life and your future. So when you're just beginning, focus on the basics. Set clear goals, build your emergency fund, choose your platform, start small, and stay consistent. The rest will come with time and experience. What matters most is taking that first step, because every investor, no matter how successful they are today, started exactly where you are. Uncertain, a little nervous, but willing to try. Once you've taken the first steps, setting goals, building an emergency fund, and putting money into the market, the next question is what strategy to follow. Beginners often feel overwhelmed by all the advice out there, from day trading to dividend stocks to index funds. The truth is, there isn't one perfect path, but some strategies are especially simple and reliable for newcomers. The most powerful is buy and hold. You buy quality stocks or funds and hold them for years, ignoring short-term noise. History shows this works. Those who stuck with companies like Apple or Amazon long-term saw huge gains. A similar and even easier option is index funds or ETFs, which let you own a slice of the whole market instead of picking winners. They're diversified, low-cost, and grow with the economy. Dividend investing is another friendly option. You earn regular payments from companies while your shares grow in value, creating steady passive income. The biggest mistakes beginners make are chasing hot tips or letting emotions control their decisions. Markets rise and fall, and selling in panic usually locks in losses. Patience is the real advantage. Think of the coffee investor. Putting aside just a few dollars daily into an index fund for decades can grow into tens of thousands. Small, consistent actions matter more than trying to time the market. In the end, successful investing isn't about complexity. It's about keeping things simple, steady, and long-term. Buy and hold. Use index funds. Reinvest dividends. Ignore hype. Stick with your plan. The market rewards patience far more than panic. And the habits you build early will carry you through your entire investing journey. No matter how advanced your strategy becomes, one thing never changes: risk is always part of the game. The difference between investors who last and those who burn out isn't that one group avoids risk, it's that they manage it. Experts set stop-loss levels to protect themselves from steep losses, and they never bet more than they can afford to lose on a single investment. But risk management isn't just about numbers, it's about emotions too. Fear and greed are the two forces that push people into bad decisions. Panic selling in a crash or chasing a hot trend at the top. Staying calm, disciplined, and long-term focused is what separates steady investors from gamblers. Along the way, it helps to borrow wisdom from those who've walked the path before. Successful investors almost always stress the same things. Keep learning, stay updated, and don't let your ego drive your choices. The market changes constantly, and the strategies that worked 5 years ago may not work tomorrow. Reading, following economic trends, and adapting when necessary keeps you sharp. Just as important is surrounding yourself with good influences, mentors, credible sources, and communities that value patience over hype. In the end, investing isn't just about growing money, it's about building freedom. When you start small, stick to smart strategies, manage your risks, and keep learning, you're not just creating wealth, you're creating options for your life. Options to retire comfortably, to help your family, to travel, to give back, and that's the true reward. So whether you're a beginner planting your first seed in the market or an expert fine-tuning advanced strategies, the principles are the same: be patient, be disciplined, and let time work for you. The market will have its ups and downs, but if you stay the course, the long-term path always bends toward growth.